This is CGTN, China Global Television Network.
Hello there and welcome to Global Business Africa. We'll be giving you insight into Africa's business and financial markets. I'm Uche Okoronkwo, coming to you from Kenya's capital, Nairobi. Let's start with a look at the markets. Now, emerging market shares were down today as investors wait on stimulus packages from central banks and governments in order to help combat the economic fallout from the coronavirus outbreak. Now, MSCI's index of emerging market shares was down 0.5% on the day. However, South Africa's JSE was on track for its second day of gains as some stocks slowly rebounded today. But the all-share still battling to recover from earlier losses in the previous session. In Nigeria, the market is still in the doldrums after seeing its biggest loss in 8 years in the previous session. Investors there have lost over $1.7 billion so far. They, of course, are panicking over the impact of the oil price war between Russia and Saudi Arabia and the coronavirus. Now, also market heavyweight Dangote Cement fell 10% today, dragging the all-share down over 3%. Now, also coming up on the show, Zimbabwe plans to move to a managed float exchange rate in an effort to stabilize its economy. Saudi Arabia boosts its oil production for the first time in more than 10 years. And this former refugee tailors a new path for the disadvantaged youth in Mali. Well, we begin tonight's show in Zimbabwe, a country that plans to adopt a managed float exchange rate, which it hopes will narrow the gap between the official and black market rate. Now, the decision is part of latest measures to stabilize a troubled economy. Here's Farai Mwakutuya with the details.
Ever since the one-to-one peg was removed in February 2019, the local unit has progressively depreciated against the US dollar. On an illegal but still thriving black market, the Zimbabwe dollar is worth less than half its value on the official central bank-controlled platform. The managed float will loosen the apex bank's control.
An electronic forex trading platform based on the Reuters system is being immediately put in place. This platform will allow foreign exchange to be traded freely amongst banks and permit a true market exchange rate to be determined.
A currency stabilization task force has been set up to monitor trading.
The central bank says it does not intend to set or control the exchange rate, but merely wants whatever level it settles at to remain stable. What remains to be seen now is if this latest policy measure will bring about that much desired stability.
The new measures are expected to subdue the parallel market for now.
Well, we're going to see that probably the parallel market rate will a bit stabilize, the volatility will decrease, simply because, of course, there's a bit of fear and panic, given that some of the measures actually imply looking into mobile money transactions and things like that. But for as long as it is very clear that the demand exceeds supply, of forex, really, those exchange rates are going to move northwards.
There remain crucial concerns.
Does the government actually have the reserves then to support a managed floating system? At this point in time, I think if you then look at economic fundamentals within Zim, you look at things such as FDI and even local production, we are quite low. So really it then raises the questions to say that will the government be able really to sustain the system going forward?
When questioned about this, the authorities were bullish.
Are these measures enough? If they are not enough, we'll add some more.
The shortcomings of the interbank market had threatened to jeopardize currency reforms aimed at restoring international investor and development partner confidence. Farai Mwakutuya, CGTN, Harare, Zimbabwe.
Well, let's take apart this new system with Farai. He joins us now in Harare. Great to have you on the show, Farai. Now, given that Zimbabwe has struggled with exchange rate distortions and, of course, a quite speculative parallel market, how do players in the market feel about this newly proposed forex trading platform?
Well, Uche, I think the reception has been very positive. I think for a very long time, people have pointed out the fact that the foreign currency allocation system as it stood prior to this intervention was not serving the purpose. Companies that needed foreign currency were finding very difficult to access that foreign currency, but also holders of foreign currency and exporting companies were not getting full value for their forex because there's such a huge disparity between the official market rate, which is about 18 to 1 US dollar, versus the parallel market rate, which is now touching 40 to 1. And so as a result, I think many people hope that this will allow holders of foreign currency and exporting companies to get full value from their foreign currency holdings, but also allow banks to play a more prominent role, a more influential role as an intermediary, linking people who need foreign currency and those who have foreign currency, and hopefully the system becoming more efficient, allowing companies that need foreign currency to get it when they need it and to meet their demands.
Right. Well, as you mentioned, Farai, the move will see the private sector playing a bigger role in foreign currency trading in the country. Banks essentially will become the market makers. So what are the measures the government will put in place to ensure transparency, efficiency, as you mentioned, and of course the overall success of this new system?
Well, Uche, when these measures were announced, there was also an announcement that there would be a currency stabilization task force that has been set up. It will be chaired by the Minister of Finance, and it will meet weekly to monitor, to assess, to analyze this trading platform, to find out, who is getting money, at what rate they're getting the money. And all this is in a bid to make sure that the system is implemented in the way that the authorities want it to be implemented, and that it meets, the objectives that it has been set out for. In addition to the establishment of this committee that will monitor these trades, the central bank will also be providing daily and weekly updates in terms of the trading platform. They'll be able to monitor this Reuters trading platform from their own office because they're setting up a desk at the central bank that will also monitor and oversee this process. So I think those measures are put in place to try and ensure and control that the system is functioning the way it's meant to function in terms of abusing the system, because in the past, Zimbabwe has faced challenges with people who are manipulating the currency, trading on the parallel market. There are also stringent measures that have been put in place to monitor and control, particularly mobile money transactions, because they're mostly being used as a conduit for transacting these funds that are being used on the parallel market. So the mobile networks will now be required to be more stringent and to be more open in terms of disclosing who is trading what, who is transferring what. There are also limits in terms of the amount of money that can be, the amount of bulk funds that can be transferred across those platforms.
Well, Farai, this platform is just part of a raft of policy measures the government says it will implement in order to stabilize the exchange rate and, of course, bring down inflation in the country. What else is Minister Nkube looking to do besides this?
Well, in addition to this, he did say that, the government will continue with its fiscal reform regime, with its cash budgeting, system, where it's effectively trying to cut expenditure, limit what it's, spending, and increase its savings. He did say that currently the Treasury is sitting on a surplus, a cash surplus of 3 billion Zimbabwe dollars. So, those fiscal reforms will continue to reduce the expenditure side. He also pointed out the fact that there is a need to revisit some of the legislation around the currency issues, in particular being more stringent and being tighter in terms of illegal foreign currency trade. As it stands, it is illegal to trade in foreign currency, but it happens frequently. It happens openly on the streets of Harare. If you walk around those streets, you'll see people with huge wads of money trading foreign currency. And so he says there is a need now to revisit those laws to make them more effective, to give them the artillery to back up and support these measures, because I think think when I've spoken to several analysts about the measures that have been announced today, for them to be successful, this managed float system needs to be backed up by resources, by funding, but also by the artillery in the form of legislation, throwing the throwing the law at the people who are manipulating the currency. So those are some of the measures that we expect will be brought in to try and back up these measures. But as was mentioned in that story, when we asked the finance minister, is this enough? He said, look, if it's not enough, there will be more. So we expect that if it's not enough, as they monitor the system, as it becomes live and it's trading and they pick up some of the anomalies and challenges along the way, they will tweak it and they will come up with more measures.
Well, as always, good to hear from you, Farai. That's Farai Mwakutuya joining us in Harare, Zimbabwe. Let's move on now. European firms plan to invest close to $750 million in Uganda for the next 5 years. The money will be invested in agro-processing, manufacturing and the service sectors. Now, the announcement came at the end of the first Uganda-EU Business Forum in Kampala. CGTN's Michael Balake was there and brings us this report.
More than 100 farms from the European Union have committed to spending money in commercial farming, tourism, oil and gas, and in green energy solutions. The investments will be channeled through partnerships with local enterprises.
This conference is really a step in the right direction, where the European diplomats take the lead and the European governments take the lead in encouraging European companies to invest in Africa, including Uganda.
The World Investment Report 2019 by the United Nations Conference on Trade and Development puts the volume of trade between Uganda and Europe at $1.3 billion in 2018, up from $550 million in 2010. Uganda's Trade Ministry projects that the planned investments are likely to triple the current trade volumes. But the investors want all non-tariff barriers addressed.
They're wary about some of the issues that are inhibitions in their doing business. For example, corruption. For example, cost of finance, bureaucracy, and others. So they're committed to help the public sector to fight.
A platform called Sustainable Business for Uganda has been created to enable continuous dialogue between Ugandan and EU companies. The forum will be overseen by representatives drawn from the government of Uganda, the Ugandan private sector, and the EU member states. Uganda and the EU have resolved to work together in the areas of tourism, innovation and ICT. They have also agreed to strengthen and support public-private partnerships with a grant of about $97 million for the next 5 years. While the event brought together Uganda-EU businesses, many local firms took advantage of the forum to partner with each other.
I have also seen so many Ugandan companies interact with other Ugandan companies, and you find that a lot of the companies can actually work together. I know for sure, for myself, I've seen a number of companies that are in coffee that we're going to work together. I know.
The European Union is currently Uganda's third major export market after the common market for Eastern and Southern Africa and the Middle East. The hope is that the new business forum will also make Uganda a significant player in the EU market. Michael Balake, CGTN, Kampala, Uganda.
And now let's take a look at our corporate headlines today. The Democratic Republic of Congo aims to reach a deal with energy traders Glencore and Trafigura. The agreement seeks to restructure $1.7 billion in debt between the Central African nation and the Swiss energy traders. That's before a meeting with the IMF next month. Last July, the fund agreed to a 3-year lending program to help Congo, but so far only $45 million has been dispersed. And South Africa's ABSA has reported 3% growth in its headline earnings, which reached about $898 million in the financial year that ended in December 2019. Now, the lender, however, saw a decline in its retail and corporate banking segments This as consumers and businesses alike feel the effects of South Africa's stagnating economy. And staying in South Africa, Old Mutual is forging ahead with plans to appoint a new CEO to replace Peter Moyo. Last month, Moyo filed an urgent application to interdict the JSE-listed financial services group from continuing with the process to hire his replacement. Old Mutual has been involved in a bitter battle with Moyo since last May, when it suspended and later fired him over alleged conflicts of interest. And finally, Chinese telecom giant Huawei has been granted another 45 days to do business with American companies. The new provisional license expires on May 15th. Prior to the extension, the previous license was set to expire next month. While Huawei was placed on an economic blacklist last May, it was still allowed to do business with its American partners for components that US says do not pose a threat to national security. And that is a look at our corporate headlines. Well, let's head into a quick break now. Still to come on the show. We'll tell you why the Egyptian pound is losing its fighting streak against the dollar. And South Africa's business confidence sinks to a 21-year low.
The world economy as we know it is about to change. Global business reports highlight emerging markets, developing countries, and dynamic sectors worldwide. We feature top analysts and newsmakers to provide perspectives on every facet of business. From an on-the-ground perspective, we provide you with balanced and objective assessments. Fast, sharp, and insightful. Global business, only on CGTN.
Every story starts out like this.
Okay. We'll head up now.
But beyond the rush of the numbers, there's always a more fundamental question. What happened? Who has been affected? When market-moving decisions are made, who's responsible? And why?
Let's get some reaction on ground. Joining us in Johannesburg is Sutra. Hello, Naro.
This is how all stories begin. See how they end. Only on Global Business.
There's more to this place than just glorious landscapes. There's more to it than just, say, Table Mountain or glorious, endless salt flats. There's more to it than countries that are home to some of the deepest mines in the world. There is so much more to this place, even if it is home to some of the finest diamonds on the planet. It is the sheer diversity of the people who call Southern Africa home, and the relentless drive to make it a better place that make it so special. And we know that because this too is home. No one knows Southern Africa like we do. CGTN, see the difference.
Africa is the nexus of enterprise, and Global Business will tell you why it matters.
From the mega investment projects to multi-billion-dollar mergers and acquisitions.
Africa today collects, just in terms of revenues from taxes alone, $545 billion a year. If you take 10% of that and you devote it to the energy sector, problem solved.
All this on Global Business, weekdays at this time on CGTN.
Welcome back to Global Business Africa. Well, let's head to Egypt now. The country's currency, the pound, is being impacted by severe turmoil in the global financial market space. Its decline also comes against the backdrop of fears of the spread of COVID-19, as well as the current drop in global oil prices. Here's CGTN's Adel El Marhoui once again with the details.
Since 2019, the Egyptian pound has gained nearly 12% against the US dollar. But in the last 2 weeks, it has lost 1.1% of its value to the greenback.
Fears from the coronavirus has made volatile investments like foreigners in the Egyptian stock sell their shares, putting demand on the US dollar. That is the main derivative from the US dollar to increase. I don't think it'll last.
The Egyptian pound is expected to keep strengthening once the fears from COVID-19 start fading. That's backed by the revenues from tourism, which remain unaffected by the virus so far. They are targeted to reach $16 billion this year.
In February, when the whole world was facing that crisis, nearly 900,000 tourists have visited Egypt, with a 4% increase from February 2019. During the first week in March, 210,000 tourists visited Egypt. This is the normal rate of visitors. The virus was spreading across the world.
With positive news coming from Huyan about corona and the news of vaccines coming out soon, the fears from the virus will go away on the medium term. And I think the Egyptian pound will then continue to rise, backed by the strong foreign currency reserves at the central bank and good USD cash flow for Egyptian banks, which together would reach $70 billion.
Several multinational institutions are backing the continuation of the Egyptian pound gains. Societe Generale expects it to reach £15.35 for $1 by the end of the year. The rate on Wednesday was 15.66. Those benefiting from the pound's depreciation should not get their hopes high yet. This fall, the EGP has taken could only be a bump on its road to once again go up. Adel Mahroui, CGTN, Cairo.
Now, still in Egypt, bond investors who came to the country to reap a quick payoff might not stick around for longer. Official data now shows that the central bank sold less than a third of its bond offering on Tuesday. That's amid pressure from investors for higher yields. The Treasury bonds were offered in 2 installments. The first is valued at about $254 million with a 5-year term, and the second worth around $223 million with a 10-year term. Now, Egypt aims to reduce its debt to GDP ratio to 82.5% by the end of June this year. Outside investors have pumped billions of dollars into the North African nation's debt market since its 2016 currency devaluation. Economists now say that Egypt faces a tough repayment schedule ahead. Well, let's discuss this further with CGTN's Adel El Mahroui. He joins us now in Cairo. Adel, always good to have you on the show. Now, given the current demand and appetite for emerging market debt, give us a sense of why we're seeing demand for some of those tranches being poor and low, and give us a sense as to why the CBE has only been able to sell less than a third of its bond offering on Tuesday's auction.
So first, let's take an overview about what's happening in Egypt, which is also happening in several emerging markets all over the world. Basically, the COVID-19 virus is causing fear. It's affecting the forex exchange rates of the Egyptian pound and the stock market. Investors, especially foreign investors, are going for cash. And therefore, it seems that there is a tendency for these turbulences, and it makes it quite challenging for the government to secure, or at least to give the sense of security to the rates is going. That's why investors who wanted to went in, Egyptian banks who went in to buy the Egyptian pound bonds offered this week were offering a higher rate than the central bank would have accepted. For example, as you've mentioned, there are 2 bonds, 5 and 10 years. Together, they make about $500 million. The shorter term, the 5-year bond, Egypt managed to, or the government managed to sell about half of that. So in terms of 5 years, the government has managed to sell it at 14.033%, while investors or the banks were asking for much higher, 60 points above what the central bank has accepted. While in the long term, it was a bigger drop. Egypt has sold about around $5 million off its target, which is about $230 million US. So it's a big gap. And the difference in the rates, we're talking about 14.458. That's what the central bank has accepted. And at the same time, the offers for the bonds were at 14.591%. So we're talking about 32 or 33 points differences. In general, that has made the bank to stop. There are two reasons for that. Either the bank was providing the 7.5 billion or the $500 million equivalent in Egyptian pounds, while it was not an emergency need for the whole sum, which could be likely or not, but at the same time, the bank or the government cannot afford to pay for that extra rates, and therefore it has not met, and it led to about 1/3 of the bonds only sold this week.
Well, looking at Egypt's overall bond sector, besides about 2 other countries, Egypt is one of the only governments globally to sell dollar bonds with yields above 8%. Does it look like market fundamentals may change anytime soon? And could this affect how we see it approaching monetary policy and rates going forward?
So basically, Egypt still has an incentive. If it remains its current rating for the euro or the dollar bond, as you said, above 8% for the dollars bonds, 8.75 even for a longer term until 2059. But still, if Egypt decided to make a little bit of a rate cut or keep it as is, it should be attractive for foreign investments, for foreign investors, especially when we're seeing a global cut in the rates in general. We've just seen what happened in London, and it took the decision to drop or reduce the rates as well. And therefore, the trend is expected. The Central Bank of Egypt will have another meeting in a couple of weeks, and it is expected to take either remain as is, which will be quite difficult because the government, as we've just talked about, the government cannot sell Egyptian pound bonds, and therefore it cannot pay for a high rates, and therefore might be cornered. There is really no solution except for the government to be able to sell bonds at lower rates so that it can pay, and then the budget deficit will be contained within the framework. But of course, it depends on the turbulences that we're seeing, how long will it stretch. So generally, there is a tendency to keep it as is, or even if it lowers it a bit, Egypt might still be attractive compared to other global markets.
Right. Well, Adel, if this current trend of investors seeking out higher yields continues, what do you expect to happen, especially because the state plans to partly finance the budget deficit through treasury bills and bonds this fiscal year? So how much will the current demand for bonds affect the deficit going forward? And certainly, what options does the government have?
So basically, the government had a very bold declaration a few weeks back saying that it has already said no to the World Bank and the IMF for future loans, and therefore it is only relying on sukuk, on green bonds, and Egyptian pound bonds as well for the loan mean to cover for its deficit and make ends meet. But basically, what we know so far from preliminary announcement is that the government is actually moving in issuing sukuk and green bonds. But of course, with the turbulences going on in the market right now, it is not the good time to offer it. And therefore, it depends. If the current situation is contained for the COVID virus and Egypt manages to maintain this tight infection rate and therefore start to bring back confidence into the market, then the government will be able to issue these new green bonds and sukuk. But if the situation gets beyond hand, then maybe the whole issue about forgetting about loans from the World Bank and the IMF might be revisited, and the government might rethink that stance as well. But until then, there's really nothing to give a solid advice to the government or the government take a solid decision unless we see how this current turbulences will pass out. Will it pass out in a couple of weeks, or will it stretch beyond the government can handle?
Well, we're certainly watching. Many thanks, Adel, for your insights. Of course, that's Adel El Maroui joining us there in Cairo. Well, let's move on now to South Africa. The country's business confidence sank to a 21-year low in the first quarter of this year. Recovery in the building, manufacturing and retail sectors in the last quarter reversed in the country. Africa's most industrialized nation is grappling with its second recession in 2 years as agriculture, transport and construction contract. Now, regular power cuts in December, news around the bailout of state-owned enterprises like South African Airways, as well as a deterioration in the government's finances and the coronavirus outbreak all led to the drop in confidence. Meanwhile, Africa's largest mobile network by subscribers, MTN Group, has announced that Rob Shotter will step down as CEO in March 2021. Now, the announcement came during the release of the company's results for the full year that ended in December 2019. They revealed that MTN's revenues rose by 9.7% in the year, while its earnings per share grew by about 39%. CGTN's Angelo Coppola has the details.
The company says it's delivered on its objectives and shareholders would be relatively pleased with the total declared final dividend for the year of 550 South African cents.
Commercial momentum, you see the business progressing across, customer, better NPS, better network quality. I think that's super important for the long term. I think secondly, progress on the strategy. So expanding Momo to more markets, rolling out the Ayoba ecosystem, delivering on our asset disposals. And of course, thirdly, we also need to deliver strong financial results. We had revenue growth, improved margins, improved HEPS growth, gearing came down, dividend came through, returns improved. So I think progress across a broad front.
There was one key material aspect which affected the MTN results in 2019, that of currency movements.
The rand actually was unusually strong at the end of the year relative to the US dollar. So that impacted our net debt position. And we recorded a net debt of 55 billion, which was the lowest that we've had for a while. That's at the holdco level. The other aspect was that the rand was actually weaker against the basket of our operating currencies, which meant that constant currency growth rates were lower than reported. So we had service revenue growth of 9.8, but reported service revenue growth was like 13.1.
The results mark several key issues that have been concerning the management team.
The complex litigation in Nigeria with the Attorney General, which we managed to resolve at the end of the year, so that was a big relief. We also managed to redeem our preference shares in Nigeria, which is something we've been working on for quite some time. I think we've managed also to improve the staff morale, the staff engagement. I'm always looking at that, because it's important that our people feel energized and engaged.
The company also launched a competitor messaging platform, Ayoba, which now has some 2 million customers.
I think the numbers look pretty impressive. I mean, obviously the South African operation is under pressure, but that's no surprise because the economy is in a very poor state right now. And we've seen other companies report poor earnings on the back of that. So I think all things considered, the Nigerian operation is doing incredibly well. We'll have to see what the impact of the falling oil price is going to have on the Nigerian market going forward.
We've seen a solid set of results here based on the economic climate in the two biggest markets. The news that Shooter is moving on is also well in advance, so there shouldn't be any market movement there. And generally, it seems like this business is ready for the next 12 months. I'm Angelo Coppola for CGTN in Johannesburg, South Africa.
And still in the telecom sector, South Africa's Competition Commission has announced that giant telecoms firm Vodacom will reduce monthly data prices by at least 30%. This will be effective from April 1st. Now, the announcement is likely to be seen as a victory for consumers. South Africans pay more for data than in any other country where the same telecom service providers operate. Here's CGTN's Yolisa Njamela with more.
Research done by the Competition Commission reveals that compared to other international scenarios, South Africans on prepaid plan are paying a lot for data, that the prices are not just higher, but substantially higher. Upon finding out about this, South African consumers took on the telecommunications giants in this country. In a social media campaign known as Data Must Fall, the consumers rallied against expensive data. Fast forward to 2020, data prices, at least for one telecommunications company, Vodacom, have fallen. All Vodacom customers are set to pay at least 30% less for their data bundles, as the mobile operator has agreed to slash its prices and provide free internet access to the poor, as demanded by the Competition Commission.
In terms of the agreement and following confirmation by the tribunal, Vodacom will introduce price reductions across all its monthly bundles and provide free access to basic internet, essential services and cheaper pricing to the poorest communities. And really, I think the agreement that we've come to is very beneficial for South Africa.
The mobile operator CEO says the company will sacrifice at least 2.7 billion rand a year as part of the agreement. The company will further decrease its bundle prices in April next year, which will mean more than a 40% price reduction overall. About 2,000 suburbs and villages living below the poverty line will get personalized discounts. The deal will also mean an extension of the number of zero-rated websites and services. Those services will include more than 20 specific government-related sites around services such as education and healthcare.
Vodacom shall extend the current zero rating to essential state and emergency specified sites. These will enable citizens to access emergency services and allow citizens to access crucial government information and services. The list extends to more than 20 sites and includes sites of the services within the Department of Health.
More and more of the core services that lie at the heart of a development agenda are now being rendered through digital means. Health services, education services, increasingly will be provided through the gadgets and the instruments that we have surrounded ourselves with. And when prices are high, it means that the power that digitization can bring to all those development services are chilled, are suppressed, are reduced. When we bring prices down and we increase access, we can now begin to create these platforms in significant ways.
Vodacom and MTN were harshly criticized for using their market dominance to maintain price discrimination strategies here in South Africa. Yolisa Njomela for CGTN in Pretoria, South Africa.
You're watching Global Business Africa. Let's take a short break. Still coming up on the show. The World Health Organization declares the coronavirus outbreak a pandemic. And the UK warns of an economic disruption due to the coronavirus outbreak.
Business in Africa is at the crossroads. We celebrate those who are adopting and thriving despite the challenges, from grassroots to big businesses. Global Business takes you along for the ride as we track the making of a giant. Only on CGTN.
How will your world change today? What happens here? What happens there? Or what you make happen for yourself? If it matters to you, it matters to us too. Your stories are the stories that need to be told. Africa Live. Find your voice.
Welcome back. Now, the ongoing COVID-19 outbreak that has swept into at least 114 nations and killed over 4,000 people is now officially a pandemic. That's according to the World Health Organization. Italy has the biggest COVID-19 cases outside China. The whole nation is under travel restrictions with stricter controls in hard-hit northern regions.
We're deeply concerned both by the alarming levels of spread and severity and by the alarming levels of inaction. We have therefore made the assessment that COVID-19 can be characterized as a pandemic. Pandemic is not a word to use lightly or carelessly. It's a word that, if misused, can cause unreasonable fear or unjustified acceptance that the fight is over, leading to unnecessary suffering and death.
Meanwhile, Britain has unveiled a budget with a multi-billion-pound stimulus package in order to help ward off the economic impact of coronavirus. Now, Britain's new finance minister, Rishi Sunak, made the announcement in his maiden budget on Wednesday. The plan to help fight the effects of the outbreak will cost around $40 billion. CGTN's Andrew Wilson gives us some of the highlights from that budget.
The Bank of England decision takes interest rates back to almost zero. They've been there before, but never lower. The Governor, Mark Carney, said it would help businesses and households manage a pending shock that could prove large and sharp, but he said should be temporary. In Parliament, the Prime Minister defended the government's strategy to deal with the coming coronavirus epidemic, as news broke that his Health Minister, Nadine Dorries, has tested positive for the virus and has now self-quarantined. And then Rishi Sunak, barely 4 weeks into his new role as Chancellor, presented an extraordinary economic budget to the House. He delivered parts of the government's agenda to massively increase infrastructure spending, a swathe of borrowing after a decade of austerity. He also mapped out fiscal measures to protect the economy from the coming coronavirus epidemic already building in the UK population. Mr. Sunak told the Cabinet that his measures on COVID-19 will make the UK one of the best placed economies in the world to manage the potential impact of the virus. All the figures at the moment suggest we don't have too long to wait before we find out whether or not he was right.
Now, a senior British government health advisor says the country is preparing for a COVID-19 outbreak to hit soon, and the peak could last for at least 3 months. Now, the disease is continuing to spread across the UK with more than 370 confirmed cases and about 6 deaths. And as CGTN's Nicole Johnston reports from London, some are starting to panic.
The reality of the coronavirus outbreak is beginning to hit home in the UK. Rows of empty supermarket shelves are becoming more common as people prepare for the possibility of having to isolate themselves at home for 2 weeks. There are signs some shops are running low on cold and flu tablets, along with paracetamol. In some supermarkets, stocks of basic supplies like porridge, cooking oil and pasta are running low. And hand sanitizer is becoming harder to find.
The British government says it will work with retailers to make sure that they can keep their supply chains running and stores full during the outbreak. But one of the big concerns is how to support the community's most vulnerable groups, the sick and elderly.
The government says within a couple of weeks, it may ask older people to stay home.
A lot of people have coughs and colds over the winter normally. A lot of people have flu. The important thing here is this is a new disease, and we need to be very careful about protecting those individuals who we think are most at risk, and that is predominantly the elderly and those with underlying chronic conditions.
And people who are mildly sick may also be asked to stay home. As for the possibility of introducing an Italian-style lockdown in the UK, the government isn't ruling it out.
We would continue to look at the evidence as we go through, but those are not the measures which are currently would appear to be the best ones for the UK population with our demography.
Meanwhile, the UK is extending supermarket delivery hours to keep supplies flowing. What happens next depends on just how widespread this virus becomes. Nicole Johnston, CGTN, London.
Meanwhile, Australia is in the midst of a toilet paper panic fueled by concerns about the coronavirus. That has prompted many supermarkets to impose loo paper limits as researchers ponder over what's behind this panic buying. Here's Greg Navarro with more.
There is little indication outside of many Australian supermarkets of the behavior taking place inside some stores. Fighting, stealing, even people slapping each other, and all of it over toilet paper.
I think it's nonsense.
Concerns about the coronavirus had prompted a run on the bathroom staple and the kind of behavior that University of New South Wales Associate Professor Nitika Garg says is less about the actual item and more about people's response to the unknown.
So I can't do anything about the virus. I can't control the uncertainty and lack of control there. But what I can do is buy some stuff. And so it's along with the herd mentality that need for control is triggering this sort of behavior.
This is the pasta aisle.
People are stockpiling other items as well, and stores are struggling to keep up with the increased demand.
At 6 o'clock this morning, a truck came in, but now it's all gone.
Many supermarkets have now placed limits on how much toilet paper each person can buy. And a truck fire recently received a lot more attention than it normally would because of the item it was carrying. The driver escaped serious injury. The panic surrounding toilet paper is even being used to help lure customers. At a house auction in Melbourne recently, one 24-pack of 3-ply paper was being offered to anybody who made the first bid. Some people have taken to social media to poke fun at the focus on toilet paper. That includes one family that mistakenly received an order for more than 200,000 rolls.
Australia suffer. We have the toilet paper.
Nitika Garg says while the panic is an explained human response to the virus, it's not a healthy one, especially where it prevents some people from getting toilet paper who actually need it.
I would like to hope that we can do better than this, right? As a society, as a community.
But at the moment, the signs are not promising. Greg Navarro, CGTN, Sydney.
Now, with cinemas across China, South Korea, Japan and Italy largely shut down and restrictions on entertainment venues being put in place elsewhere, the coronavirus outbreak is taking a toll on the global box office. And the cinema industry as a whole is facing turmoil.
Disney and Pixar's Onward led the weekend box office, debuting in the U.S. to $40 million. According to the trade magazine Variety, the film took in $28 million internationally, bringing in a global total of $68 million US. The animated film, voiced by Tom Holland and Chris Pratt, ranks among Pixar's lowest opening weekends in modern times. It was unclear whether coronavirus fears played a part in the movie's global debut. But according to Screen Dailies, Onward did not open in China, Japan, or South Korea, and it also failed to make the screens in Italy, Australia, New Zealand, or Turkey this weekend. China's cinema industry has been particularly badly hit by the coronavirus outbreak, with many theaters shut as part of measures to curb the spread of the virus. Box office revenues in China fell 80% over the first 8 weeks of the year, according to Morgan Stanley.
Well, I think for the global film industry, it's a disaster, just like the airlines. Because in China, all the cinemas are closed. They are not yet closed in Europe and America. But China is the #1 theater market in the world, the movie market in the world. It stopped already.
Chinese media reports say the Shanghai Film Group is due to set up a billion yuan, or $143 million fund with partners to help some Chinese cinemas cope with the impact of the outbreak. The company says the funds will be mainly used to support movie theaters in the Yangtze Delta region. Screen International editor Matt Mueller said he expected the outbreak to impact smaller, highly leveraged and debt-laden film companies.
If you're a major studio like a Disney, you clearly have the sort of the resources and the depth to sort of ride out a situation like this. If you're a smaller company where you have a high amount of debt or you're highly leveraged, then you're going to be in a sort of more precarious situation. And I think that is the situation for some smaller cinema chains in particular. And then production companies, producers, if they're not getting their projects made or they're not able to sell them in the market, which of course is a danger if Cannes doesn't happen, where film sales is such an important part of the whole marketplace, it does put pressure on smaller companies for sure. And there could be redundancies, there could be, even some closures if it lasts for a very long time.
In Italy, which is facing Europe's most serious outbreak of the highly contagious virus, the government has ordered all cinemas to close. But some markets such as Russia and Germany remains relatively unaffected from now.
Oh, this one is cute. You've got car insurance.
And the industry is hoping, perhaps against hope, that despite the increasing concerns and panic, people will still want to and be allowed to go to the cinema all the same. Shen Li, CGTN.
Well, let's shift focus now. Here's a look at how commodities performed today. Oil prices headed south today, giving up earlier gains. They continue to feel the pressure of a decision by Saudi Arabia to boost oil production and, of course, weakened demand due to the spread of the coronavirus. Also, U.S. crude oil inventories rose in the most recent week, adding more angst to an already volatile situation. Gold prices, on the other hand, regained some ground after Tuesday's near 2% slide. They continue to be driven by developments in global financial markets, which in turn are driven by developments around the coronavirus outbreak. Spot gold climbed as much as 1% on the day. Now, other metals like copper steadied today after touching a 3-year low on Monday. Let's take a short break now, still to come. A former refugee empowers the youth using his tailoring business in Mali. And thousands of participants from across Tanzania are at this year's Innovation Week in Dar es Salaam.
Images may appear to be identical, but looks can be deceiving. The difference is not always obvious. It has to be discovered. There are always different sides to a story. We put the focus on the details. To see more, to understand better. CGTN. See the difference.
You don't find the stories of North Africa by sitting on the sidelines. No one else will take you where we can in North Africa. And no one else will show you what it's all about. CGTN, see the difference.
Now, a former refugee from Mali has returned home to start his own tailoring business. Packed with valuable skills he learned in Burkina Faso, Sidi Ould Amin is offering support to other refugees now through vocational training in order to help them become self-reliant. Here's CGTN's Brian Toussaint with his story.
In 2012, hundreds of thousands of people from Mali fled to Burkina Faso after conflict erupted. Armed rebels and government forces were at loggerheads over independence and greater autonomy for the northern region. Sidi Ould Amin is among those who chose to seek refuge in a bid to ensure safety for his family.
We became poor people. Before we were fine, but after this tragedy, the destruction, stealing, strikes, we have nothing left.
While living at the refugee camp, Sidi engaged in a training program ran by the UN Refugee Agency, UNHCR. He was adamant on turning his fate around through tailoring in the hopes of becoming self-reliant.
When I was informed that there was a tailoring program, I decided that's what I would prefer to do because my children's clothes at home are torn.
After returning home back in 2017, Sidi set up a tailoring business in Mopti. He can now provide for his family and train youth from disadvantaged communities, helping them acquire tailoring skills.
This has become a small school as well. It prevents youth from straying or begging. They can benefit from the little experience I have.
By February 2020, over 130,000 refugees had fled Mali. Those displaced sought refuge in Niger, Mauritania, and Burkina Faso, which are also grappling with insecurity and staggering levels of displacement. Despite the enduring threat, some 70,000 Malians have chosen to return over time to areas they felt were safe enough to go back to. Brian Toussaint, CGTN.
And in Tanzania, the Dar es Salaam Innovation Week has kicked off. It is a series of events exploring innovation in research, entrepreneurship, technology, and design. Now, the purpose of the event is to inspire current and future leaders to take risks on new ideas to transform the East African economy. With more on this, here's CGTN's Daniel Kijo.
Themed Innovate for Impact, this year's theme has brought together over 6,000 participants countrywide. Started 5 years ago, this time around, Innovation Week will not just be in Dar es Salaam region, but also Arusha, Iringa, Zanzibar, Dodoma and Mbeya. The government now says it will continue to support Innovation Week because it is at the core of its industrial drive.
Local innovations are very important. We cannot, try to achieve an industrialization agenda based on borrowed technology only.
There will be over 70 events happening throughout the week, ranging from discussions, hackathons, workshops, panel discussions, demonstrations, and more. The organizers believe that events like these help connecting innovators to other financial sources and support them to become sustainable. But he says more needs to be done to support local innovators.
So what we need to work on right now is basically to have the policymakers understand how they can be able to support innovation through some kind of innovation-friendly policy framework.
Tanzania's second five-year development plan stresses on industrialization as a catalyst to achieving middle-income economy. So it's hoped that events like these can be the right engine to make that a reality. Daniel Kijo, CGTN, Dar es Salaam.
Well, before we go, here's a quick look at Africa's currencies today. South Africa's rand weakening as, of course, the market saw another bout of risk aversion. Investors are fretting over additional cases of coronavirus confirmed in the country, as well as Eskom's move to intensify load shedding to stage 4. Meanwhile, Kenya's shilling strengthening today, supported by dollar inflows from NGOs. That's amid subdued buying activity from merchandise importers in the country. Well, that's it for this edition of Global Business Africa. Remember, you can send your feedback to the contacts on the screen. You can also follow us on our very